Good time then to bring in another market expert. Vetri Subramaniam, CIO at Religare Invesco Mutual Fund, joins us on the show. Vetri, hi, morning. The developed markets have been quite the stars of 2013. Nasdaq risen, 53%, S&P up 44% compared to DAX and Nikkei at 43, which are not really far behind. What's the case with the emerging market pack and in India? And do you see this order changing somewhat in 2014?
Well, I think the multiple reasons for why the developed markets have actually surprised and done much better than emerging markets this year, including the fact that I think growth has actually surprised positively in those economies, whereas if you look at emerging market economies like India or for that matter any of the other BRIC economies, growth has actually been disappointing. And add to that, I think the currency-related fears that were there in the middle part of the year related to Fed tapering means that when you look at it on a US dollar basis, performance in emerging markets has been even weaker than it has been in the developed markets. But I would also highlight this, that if you look at the performance of most equity markets during calendar 2013, it doesn't matter whether it's emerging markets or whether it is developed markets, the markets have been led more by PE re-rating rather than by earnings growth, and therefore I think in that sense the pattern is actually more similar across markets than dissimilar in terms of it really being more about investors re-rating or changing their pricing that they are willing to pay for markets rather than necessarily earnings growth itself starting to accelerate. So that's actually a pattern that's visible across the world.
Right. Vetri, so at the current juncture, how would you, let's say, map the market environment with valuations? Surely we have an economic bottom in place, things are looking up, but markets are no longer cheap. Sensex is trading at about 14-15 times, quality stocks are still expensive, and markets clearly are paying a price for that visibility.
Right. I think if you look at it in terms of valuations, you're right. We are trading close to long-term historical valuations. We prefer to look at it on a trailing basis at this point of time because, frankly, the visibility on earnings growth is still very, very weak. It's not completely clear to us that the economic cycle has turned up. There are still, I think, signs indicating, stress for the economy. So I still think, when we talk to corporate India, we aren't really seeing any of those green shoots, which would, give us a little bit more optimism. But from a valuation perspective, as I said, you're trading in line with the average. So you're not bargain basement cheap, but neither are you expensive. And which is why our focus right through this year has been really more to focus on the stock picking. We've been willing to look at opportunities in the cyclical space where we think valuations were at a significant discount to trailing averages. And at the same time, there are high quality businesses which are expensive, as you said. But in many cases, I think in some of these so-called defensive areas, the valuations had become extremely expensive relative to the markets and also relative to their past history. So in that sense, for us, it's been a year in which we've continued to take money off some of the extremely expensive consumer-related names and rotated it into more cyclical areas of the market where we think valuations are far more conducive, though, truth be said, earnings visibility for that part of the market is still very, very weak. But I think when you look at it from a more medium to long-term perspective in terms of where we want portfolios to be positioned, we are happy to take that cyclical risk, and that's what we've been doing.
Vetri, if I look at the market pattern, companies which are sitting on huge amount of debt, they are making a comeback. 6 months ago, debt was considered as a dirty word, but now there is a basic assumption that companies which are sitting on assets, they will be able to turn around, they will be able to reduce their debt. Is that the top theme for 2014? Look at the cyclical end of the market, look at the dirty end of the market?
Not really. In fact, our view has been the exact opposite, which is that while we've looked at cyclical businesses through this year and, we've added a lot of names to the portfolio, our thought process has been more to focus on the companies which do not have balance sheet issues, because really the truth is we don't know at which point of time this economy is really going to get some kind of momentum going. But it's very important to be invested in those companies which are still at the start line when the economy starts to improve. There's no point being invested in a company which doesn't even make it it to a start line when the economy starts to improve. And we don't know whether we are 6 months away from that kind of a pickup in economic growth, or whether we are 1 year away or 2 years away for that matter. So that's really been our thought process, to stay away from companies with the debt overload. Now, separately from that, clearly there will be an opportunity in companies which go through a genuine round of deleveraging and asset sales. We have seen some very strong performers come through in companies where corporate action has taken place, where ownership change has taken place, and which has been accompanied by deleveraging and changes in strategy. But many of these are time consuming, and deleveraging in some of these companies will involve significant level of decision making, and also significant passage of time to see whether the companies are able to pull it off significantly. So we are happy to look at some bottom up opportunities in the deleveraging arena, but it's not something that hugely excites us, because some of these companies are so badly damaged in terms of debt overload that even selling one or two assets might not really change the situation very dramatically for them. So we are more focused on being positioned in companies which are, so to speak, the last man standing, rather than companies which are, still, so to speak, weighed down by the debt burden.
Vetri, would IT make it to the list of your top calls right now?
Yeah, I think in some senses, the only part of corporate India which is exuding a bit of optimism at this point of time is the exporters. And, it doesn't matter whether these are IT exporters, whether these are pharmaceutical companies, or for that matter, these might be, the classical textile exporters, leather exporters, engineering goods exporters. So, these are the companies who are really seeing a significant tailwind on account of currency, and they have two choices. They can either use this to, increase their margins, or they can use this added spending power that they have to gain market share and make investments in the front end. And so across the board, all the large exporters that we are talking to are using different strategies to try and capitalize on this weak currency that they now enjoy. And as a result of that, I think across the board, whether it is IT, whether it is engineering goods, pharmaceuticals, I think the credible exporters will continue to be a very strong theme in this market, because they were already credible business models in the first place. They were globally competitive, and this currency depreciation over the period of the last 12 months has given them an additional tailwind, which many of them will be able to capitalize on. So, whether it's IT, pharma, engineering goods, all these exporters, I think, are, seeing a benign tailwind at this point of time, and it's something positive for them.
Vetri, off late, there's been emergence of newer sectors and really beaten down ones. We saw that yesterday with real estate as well as NBFCs, in particular the housing finance lot as well. Anything that interests you over there?
No, I think we need to be a little bit cautious here. I mean, go back and look at the last 4 years and look at how many times some of these debt-laden companies with, lack of P&L traction as well have, bounced 30, 40, 50% multiple times over the last, 3-4 years. And still, if you look at them compared to their 2009 or 2010 highs, they are off 60, 70, 80%. So, I wouldn't get too excited about the fact that some of them are up 20, 30%. Bottom up, if it's a credible story, it doesn't matter if it's up 80%. It might still be a good name to look at. But don't get carried away by these bounces. This is a little bit like a ball which has been dropped from a big height. Every time it, bounces a little, but then it, falls back to the floor again. And that's really the case when you stand back and look at the picture over a 4-year or a 5-year horizon, rather than look at the last 3 months.
Would you recommend that those who've not participated in IT stocks, they should still participate now? Because optically the P multiples for a TCS or a Infosys or HCL Tech, they are not looking stretched. TCS is trading at 20 times, Infosys still in teens, HCL Tech 17, 18 times. So even after the recent run up, the valuation is still on your side.
Yeah, I mean, we don't really make recommendations to people, so I'm not going to do that. But yes, our portfolios are currently overweight IT. We don't think the valuations are particularly stretched relative to the sector's own historical track record of valuations, or relative to what we think are their near-term growth prospects. So we are currently overweight the sector in most of our funds.
Vetri, even though Nifty is not far away from an all-time high, no one is feeling happy, no one is feeling excited because no one has participated. So do you think lack of participation and the overall pessimism will be the key driver for 2014? Because the minute the retail needle swings, that could be a big game-changing event for Indian markets?
Yeah, I think the sentiment issue, Nikunj, runs far deeper than just the fact that retail has not participated. I think we have to recognize the fact that this is an economy which has been going through severe stress over the last few years. Large companies are going through deleveraging. They are laying off people. They are not adding new jobs. Income growth in corporate India is showing all signs of slowing down. So really, from that point of view, you have to ask yourself who the Indian investor is. If the Indian investor is a salaried person, if he is a professional running his own small-scale business, if he's a large entrepreneur, all of them are facing facing challenges in their businesses. Their confidence is at an all-time low. Small companies are the biggest defaulters to the banks, as you're well aware. Large companies have got projects stuck all over the place. You can look at the CMI data, more than 10 lakh crores worth of investment stalled and cash flow not coming through. And as I said, job creation engine has also slowed down in the last few years. So really, there is very little for investors when you look back at them and look at their source of income to feel optimistic about. So I think it's a little bit short-sighted to talk about the fact that, retail is feeling negative because they haven't participated in the market. I think it's actually far deeper than that. If retail is negative, it's because they're not feeling good about their own, career prospects, their job growth, their income growth. Job creation has been at a weak ebb, and that is really the challenge.
Indeed it is. Vetri, what about the RBI action though? In yesterday's interview with ET Now, Raghuram Rajan has said that he didn't want to over-tighten in an economy which is not really showing as much strength, and perhaps tightening may have not really tamed down inflation. If inflation doesn't come down by next month though, do you think there is a chance that the RBI may hike rates, and that may come about even before the policy is lined up next month?
I think the governor is taking a fairly balanced view of things in that sense. So he is, I think doing a good job on this. It's a little hard to read between the lines over here. On the one hand, the governor said he didn't want to react to the incoming data, but on the other hand, the policy very clearly says that we'll continue to watch the data and react. So I think somewhere, policymakers in general will have to take that call. And this is true not just of India, this is true of the rest of the world as well. I think in some sense, the central bankers are just, obsessively focusing on every, change in temperature in the data readings as they come through. And there are just far too many data points that we are getting. And, as the governor rightly pointed out in India, you're meeting every 6 weeks. Maybe they should, in fact, back off on that. Central banks have the right to change policy when they see fit. They don't need to meet every 6 months and then try to justify why they acted or why they did not act. So I think there's just a little bit too much of focus on these central bank actions. I just think the RBI needs to be a little bit more categorical at this point of time in terms of what their objective is. Is it really inflation, or has growth slipped to such an extent that they now think that supporting growth is an equally important and challenging task for them? So I think, they could just give a little bit more of direction on which of these two objectives is now more important to them. That would be far more useful than, reacting to every inflation data point and deciding whether that actually required a hike or not. To put things in perspective, if I recollect right, in November, after the governor did an impromptu press conference, almost every economist in town expected that in December there would be no interest rate hike. But last week, or rather week before last, when the WPI and CPI data came out, then everybody, changed their forecast to hike. So, I think it's good that the governor is not being too reactive to data. But at the same time, I would also suggest perhaps, we need to back away from this once in 6 weeks approach to monetary policy and give the central bank more breathing time. And they always have the right to act whenever they choose to.
And that's what I think the US Fed is also doing. First, they indicated about tapering, then they delayed tapering. When they announced the tapering quantum, it was very, very negligible. So I guess central bankers are clearly changing their policy stance depending on the way how things are progressing. So, Vetri, what is the bottom line here? What do you think will influence the script of 2014? Earnings, elections, macro recovery?
Yeah, there are various events that will happen throughout the year, but I don't want to focus on those events because, it's good to talk about, but they're not really, in our opinion, the long-term drivers of the market. I think there are only two key issues. One is that valuations in India on an average basis, if you look at the aggregate market valuations, are now trading in line with historical averages. So, really for the markets to make significant headway from here, we need earnings growth to start to recover. You've had I think 2014 may well end up being another year of single-digit earnings growth. So you've had 3 years in a row of single-digit earnings growth. And really for the markets to push higher from here in terms of valuation, you need an earnings growth recovery. Our thought process for the last 12, 18 months has really been that this is a market in which bottom-up stock picking is far more important than trying to read the macro cycle and its implications for sectors, because there is a huge dichotomy which is already visible in the valuations. So, our focus has been more on bottom-up stock picking, and I think at this point of time where frankly the economic news is still, bordering between mixed and pain, we would stick with that bottom-up stock picking strategy rather than excessively obsess about the macro.
Vetri, you are bullish on IT, but what also has supported IT is a weak rupee or strong dollar strength. But now that the CD issues have been fixed and tapering is no longer a huge concern, one would imagine that rupee may not really follow a weak trajectory. So in the light of a stable or a strong rupee, does IT has potential to outperform?
There are 2-3 issues over here. One is what is really the demand environment for these companies. Remember that the US economy GDP data for the last quarter has now been revised up to 4%, which suggests that the US economy is not doing all that badly. It may not be doing as strongly as some of the US policymakers might want to, but they've actually bridged the growth gap towards relative to India quite dramatically. But the bottom line really is that the demand markets for IT services, which is the developed markets, are exhibiting reasonably good rates of growth, and therefore one has to presume that the demand environment for these IT companies is fairly conducive. Secondly, as I said, we're not really betting necessarily that the rupee has to continue collapsing from here. This is really money in the pocket of the IT companies which has been given to them by way of the currency fall, and as I said again, it's their choice how they decide to use this spending power that they now have. They could use it to gain market share by using pricing as a tool, or they could use this to increase their front-end capabilities in key markets like the US or Europe and use that as an opportunity to go up the value chain. So they really have this optionality which has been given to them, which is not necessarily an optionality which is currently available to companies which are operating in the domestic environment, selling goods and services to domestic consumers. So on a relative basis, they are very well placed because of what is happening both in terms of growth and their ability to spend to gain market share and grow revenues, and that's why we'll still be optimistic.
Okay, Vetri, good chatting with you.